Thank you. I'm Helen Tarnoy. I'm the Managing Director of Aldrich International, which is, I suppose you would call it a classic IPP, independent power company, in that we develop, finance, construct, own and operate independent power projects throughout sub-Saharan Africa. We don't work in North Africa, and we didn't by design intend to work in South Africa, but we fell into the Kelvin power plant for the third time in my case, and we're still there. We have an operating power plant in Mombasa in Kenya. We have a 310 megawatt wind farm in construction in Kenya, and a 450 megawatt gas-fired OCGT plant in construction in Nigeria. We're also working on earlier stage development projects in Tanzania, Chad, Malawi, South Sudan, and the Gambia. So it's a lot of people go to the easy countries. We're also prepared to go to the harder countries. And I'm very happy to be here and amazed to see that there are still some people standing, or at least sitting, after such a long session.
And the next question then is for Helen. Helen, you represent a wide range of investors, ranging from DFIs, NGOs and CSIs, as well as private equity players. How have you managed to align the risk appetite and return expectations of your various investors as and when you develop and finance projects on the continent?
With some difficulty, I think it's fair to say. Nevertheless, I think we are an interesting animal, or we think we are, because although we're a private company based in London, our biggest shareholder by far is the Pan-African Infrastructure Development Fund, which is based here in Johannesburg. And in that fund, the biggest investor is the Government Employees Pension Fund, who is sitting here deliberately not looking at me. So, in addition, we have co-invested quite recently with GPF in refinancing the equity in the Kelvin power plant with a view to its future life. Its PPA expires in 2021. We had to look at what happens after that, and we're in discussion with the city of Johannesburg about that. And that's in itself an interesting conundrum in the light of what we've been hearing earlier today and yesterday, because the tariff for that power plant is paid in rand, as you would expect. The fund, my fund, the Pan-African Infrastructure Development Fund, is a dollar fund, and it also raises questions, of course, if we replace this very big, very old power plant with something even relatively modest like 300 megawatts, which will be half its existing size, we're looking at an investment of over $1 billion. And has the city or does the province have the credit worthiness to support that investment? So all of what we've been discussing today and yesterday is almost encapsulated in this one project. But I was also asked to look at why we don't see more pension funds, municipal funds, sovereign wealth funds indeed, investing in power assets around sub-Saharan Africa. I can only talk about the independent power sector for obvious reasons. But I think in many ways our interests are aligned, no matter who we are. And why do I say that? Firstly, because these independent power assets are almost exclusively, unless they're very small, they're project financed. And the discipline of project finance puts such a robust structure around these projects that they are shielded from a lot of the risks to a greater or lesser extent that we've already been discussing. We have political risk insurance. We have currency management facilities of one sort or another. The risk we find very difficult to handle, of course, is currency availability. There's a difference between currency convertibility and the theoretical ability to take it out of the country, but if it's actually simply not there, what do you do? And that's a looming problem for a lot of these projects in Africa. But nevertheless, power projects by their nature, they have long-term stable returns unless your customer doesn't pay. And we heard yesterday from Globalec that they have a notoriously non-paying customer, at least one. We tried not to go into places where our customer is not going to pay, and we try to put systems around it to ensure that if that customer doesn't pay, somebody else does. I think a very good measure of that is what we heard earlier today about whether governments pay their bills. That's a good indicator of whether you will be able to collect as a utility, pass the cash on to the generator who's delivering the power. None of us wants to turn off the plant, as Henry is threatening to do, and none of us wants to lose our power purchase agreement. As an independent power producer, the most valuable possession you have is your PPA, and you will do almost anything to keep it, because that's your business, that's what you do, that's your livelihood. So I would urge institutional investors to continue to look at power as an asset class that is worthy of consideration for investment. It's not easy. These project finance deals, there's a penalty for terminating the financing early, and when all's said and done, normally you will find the sponsors and the equity will stay with the project. So effectively, you're looking at possibly refinancing debt with equity, which is normally a no-no. So your debt has to be very expensive, and your institutional investor has to be prepared to take quite a low return to make it worthwhile doing that. But I still think it's worth looking at. Thank you.
Thank you, Helen.
Doing business in Africa. You can't afford to be without Africa Investor.